On today's podcast, we were covering a very interesting and emerging topics in the market and in generally policy environment. First of all, the ongoing Niger situation. You might not know, but it has a direct implication on the assets you are trading. So we covered, of course, some of the products they produce, how they will impact the price of oil, the price of energy, and of course, what a lot of traders are following, that is inflation, which we expect it to drop on 10th of August. And we also went overboard to the other side of the Pacific, America, where we are having, of course, the ongoing election campaigns, a little bit on what is expected to be a very interesting fight between Elon Musk and Mark Zuckerberg. You will want to tune in to see which side Rufus chooses. And then we flew the other side to China, where we covered how their GDP is growing and, of course, its implication to the energy market. I hope it is a very educational session. Hey guys, I hope you're having a wonderful day wherever you are. Besides the Nairobi cold, keep warm. How are you doing, Rufus?
I'm doing fine.
Yeah, like you said earlier, real men don't sleep.
We are monitoring the Niger situation.
Yeah, is it Niger or Niger?
I actually had to look that one up.
Yeah, it's a very tricky word to pronounce.
Around here, we normally say Niger, but the actual pronunciation is Niger.
Yeah, because of their French colonial.
Yes.
Yeah. Since the last time we had this conversation, there has been a lot of geopolitics. And this year, we have had significantly couple of wars,
Yes.
from Eurozone to some tensions in Asia.
Yeah.
And now it's back home.
Yeah, and an oncoming fight between Elon Musk and
Yeah.
Zuckerberg.
Which side are you on?
Elon. I know he's not the fit guy, but he's a smart guy. Probably win.
Yeah, based on what happened to Anthony Joshua with the previous fight, he might not be the fittest, but he might win.
But this other guy, Zuckerberg, he trains every day. He's very fit.
Yeah.
So if he underestimates Elon, he will lose.
Yeah, that's why I
Then
said.
if he's serious about it, he can win. He also has some really good chances.
You remember that fight, Anthony Joshua on the desert with the other guy from Mexico? I forgot the name.
Yeah, I remember the fat guy.
He was beaten proper.
Yeah.
So you might be lean, but it doesn't guarantee that you'll win the fight. If they have a good referee, you might have. Anyway, so that's enough of war. So Niger, for me, what is very interesting to it, picking up from the conversation we had with Bernard the other time, Wagner is involved, so that means Russia is involved in some way.
Yeah.
And most importantly, and notable of all wars, unfortunately, in Africa, uranium.
Yes, uranium.
Yeah, and there's a tweet you just did a few minutes ago about Russia planning to build some, I think it will be nuclear enrichment plants.
Yes, Russia has been selected with Korea to build a nuclear plant in Uganda. And that will be a game changer for Uganda. I think any nation that is able to transition its energy source, make it readily available and cheap, then the overall result is usually some very fast growth.
Yeah, what I get from this, I know most of the geopolitical issues is not really affecting a lot of traders, but I think it has some significant impact to especially those who ply with the CHF currencies and obviously European pairs. Number one, we have had Italian Parliament put in a windfall tax on of 40%, I think, on their profits.
Yes.
I was listening to a commentary from an Australian trader. He was saying that he didn't know Italian banks make so much profit, given the history I've had with them regarding debts and the ECB.
Actually, those guys are holding billions worth of dollars in profits that they just made since the ECB started hiking interest rates.
Yeah.
So normally, you can't force banks to give more yield to people who are saving in their accounts.
Yeah.
So when the interest rates started going up to record highs in the Eurozone, the banks would cash in on that. They would make more money out of depositors' money by lending it out at higher interest rates. But then once they get this money, they don't redistribute to the depositors So they hoard all those profits. So as a result of that, that's why they had to implement the windfall tax, basically saying that all the money that you guys made, we are taking a 40% cut. So it's a one-off payment, but it sent European indices down quite a number before they started recovering yesterday.
I'm looking even at the chart of Euro CHF.
Yeah.
And today it has been very aggressive. I think it has appreciated by almost 0.25%.
Yeah.
And that means at least the CHF is taking a beating regarding that. Coupled up with this, France is one of the small economies in. It's a large economy, but not really a big player within the market movers within the Eurozone. So
I think it's the second biggest in the Eurozone after Germany.
What about United Kingdom?
Brexit.
Yeah.
Yeah. So after Germany, it's France, and maybe you look at countries like Spain, Italy.
Yes.
Yeah.
Now, part of why I'm bringing all this together is because obviously one of the largest exports from Niger, as it is that they do export uranium.
Yes.
And we have seen Eurozone basically try to move away from fossil fuel dependency to, of course, they say clean energy.
Yeah.
And based on what happened with the Ukraine, of course, the pipeline from Russia was cut off.
Yeah.
So it has a direct implication. If at all the uranium and the energy that they need to produce from nuclear plant is not there, it means that they'll have to, of course, go back to fossil fuels. You can't lie to each other.
Yeah.
And they don't have hydropower. So that means one thing. Demand for oil will definitely spike. And we have seen it spike already despite Chinese.
The last 4 weeks.
Yeah.
We've had a 4-week rally in Brent oil prices.
Yes.
And this is bringing back the threat of inflation, especially within the Eurozone.
Yeah.
So you see, like, there's a very strong positive correlation between the price of energy and consumer prices. So we saw the biggest challenge that the European region is facing is a high inflation, and a lot of these can be tracked back to high energy prices. Of course, the assets that were printed during the COVID period.
Yeah.
So a lot of those assets haven't quite been removed by quantitative tightening. And of course, high energy prices added to the problem, which led to the current inflation problem.
It's actually very interesting. Like I mentioned earlier, this wars or conflicts or coups, however you want to call it, or disagreement, if you put it like that, at some point, they have one effect. Last year, remember when Ukraine crisis hit, we had oil going up within 2 months, all the way up to $130. And I think we have been following it with you over the last couple of months. In fact, as we record this podcast, this is on 9th of August. On 8th, we had a very sharp drop before an impressive recovery in the afternoon until I was shocked. I know we don't have major news that is moving it, or even Chinese growth has slowed significantly. And it didn't really suppress the price of oil. Today, we are expecting the EIA report, and based on some of the analysts within the energy sectors, they don't believe U.S. adding crude oil production will really impact the price of oil or the supply of oil, given the SPR is actually declining.
From the last report, U.S. oil producing companies are operating at over 90% capacity. And somehow they're not able to feed the entire market the way we were seeing before COVID. So now that we consider that the US has run down its SPR reserves, we know that the US is targeting every time there's a low price in oil, it wants to buy at a lower price. So there is a lot of speculation happening in the market right now. So we saw the announcement by Saudi Aramco when oil prices were going down, and immediately they switched to higher prices. It's the same thing, same game being played by OPEC. So whenever we see oil prices dropping, they come up with an announcement saying that we are going to add additional cuts to oil production, and this has often led to higher prices.
It's actually very interesting. We are in the process of quantitative tightening, but it isn't really doing its job. I think if you look at everything in general, based on the last FOMC meeting for a lot of traders, one of the key highlights for me was that two data sets you are supposed to watch as a trader for the next coming 2 months, that is August and September.
Yeah.
NFP,
Yeah.
which came out very impressive.
Yes.
It added a lot of numbers, and
Yeah.
the problem was the other data set within it. Wage growth is going up,
Yes.
so it is really suppressing.
Yeah.
The dollar is really strengthened given the expected actions. The several Fed speeches we have had, we have seen them still maintain the same hawkish sentiments that we need to keep the rates elevated. And number two, look at a possibility. If the inflation is still way too high, we can as well add another 25 basis points. So it seems something in the lines of soft landing is not really into consideration, and therefore active management is really called for at this moment. For the next 2 months when we are having a sort of a summer break, I think active management of your positions, of your trades is really essential, because whatever happened on ANFP, we do not expect the same to happen tomorrow. That would be on 10th of August when CPI drops out. So volatility is expected to, of course, continue going up. I think right now it's around 17. So I personally expect it to go up.
The funny thing is that today we have seen US equities recover. The dollar index is continuing to trend higher. But then when you look at the Fed futures, they're actually pricing in a very small possibility of a September hike. Currently, I think it's around 18%. Meaning that there is a very high possibility that the US will hold rates level. So back to the same balancing factor that you were talking about last time, where while the Fed is very aggressive in tightening policy, the government is spending more and more. So with fiscal budgets expanding, it's creating some form of balance. And this balance is basically pushing up asset prices. But I think there will be a stop. At some point, the music will stop and things will start reshaping.
There is this, what we are analyzing a few days ago, and we have been monitoring it a lot. And I think we have discussed it for the last almost 3 months. The significant number of hedge funds which have a short positions on a couple of US stocks. And despite all the negative sentiments in markets, the equities market is quite resilient, posting good numbers. I think based on all the S&P 500 companies, 85 of them that have done their Q2 earnings, a significant number of them have actually beaten their estimates by an impressive figure. So you wonder, is it because investors are generally optimistic of the economy growing, the US economy, or is it that they are still holding on to their position until such a time when they see the Fed maybe start cutting down the rates, and then now they can cash out on their profits?
I think what's happening, we've been talking about the US interest on debt. So with the US debt going above 32 trillion, they are basically paying an interest of about $1 trillion per year. So a majority of these bond payments are going back to the economy. So it's acting as some form of stimulus. And at the same time, the government is expanding its spending. So since the debt ceiling was suspended, the US has already expanded its deficit spending by over $1 trillion. So as a result of that, there's just new money being pumped into the economy. Remember, we are going into an election year, not in Kenya, in the US.
I mean, so, in Kenya,
definitely,
it's campaign period or something.
We know that US leaderships have this habit of propping up the markets as they head into elections so that they can get favorable results. So we saw it happening with Trump, we saw it happening with Obama, and now we are seeing it happening with Biden. So there's that overall expectation that they'll keep propping up the markets, but then some indicators are quite to the extremes, indicating a potential recession coming up.
Now, adding to that, you will notice that what you have just said in regards to debt ceiling, in regards to their debt obligations, those are some of the key highlights that Fitch basically used to downgrade them. Because you notice that they said it would be better if the US got rid of altogether the entire debt ceiling, because that would mean that they would have to find a way to ensure that they pay their debts, be it if it is selling state assets, if it is the balance sheet of the Fed basically expanding to infinity. Obviously, that would make it sort of sustainable, something to address in the future when the rates start coming down.
Remember, this same week, Moody's basically downgraded 10 US banks,
Yes.
majorly small and regional banks, and also mentioned that a couple of more mega banks are under investigation and they could as well get downgraded in the near future. So there's this thing happening with the US bond markets where yields are continuously rising as our bonds become more riskier, but then bond prices are actually going down. So the majority of holders of this debt are basically holding onto losing positions. You're holding a bond that is worth less than the par value and way less. But then if you hold it to maturity, you're guaranteed to earn that, but you can't sell it off in the markets, which basically removes liquidity from you. So the only way the Fed tried to fix this is by creating the BTFP program, where if a bank is overstretched, let's say there's a bank run or they can't meet their obligations, they can borrow short for 1 year from the BTFP program, and then they will pay that with interest, but then they will have fixed their whole.
Okay.
But then here comes another side of the equation, where there's a lot of banks with exposures in commercial real estate, and that is not doing well. Prices are actually going down as a result of the illiquidity currently happening in the real estate sector. So besides people not taking on new mortgages at these interest rates, there's also the challenge of people being unable to pay. Sorry. And the third one is low occupancy rates. So all those problems combined together, they create a very difficult situation for banks.
Yeah, I think on low occupancy rate, I was reading a report, and I think readers can go and just Google and see.
Yeah.
WeWork, the basis of their company is people renting out their spaces for different startups or businesses that you conduct.
Yeah.
And they are reporting very low numbers in cancellation of that because people are now going back to work.
Yeah.
And a lot of hedge fund managers have started asking the employees to go back to work, and even big companies, because as much as hybrid working is okay, they will notice that by Friday 12,
venture capital has really gone down.
Yeah, the laptop are basically on, but the owner is not there.
Yeah.
So people have been they have been receiving basically low revenue, and I think they are also considering either winding up or selling shop.
Yeah.
And it's actually very interesting.
When was the last time you had a new IPO in the NASDAQ or New York Stock Exchange?
That is very exciting or interesting. None. I hope X do list some point.
Yeah. I think there's some IPOs happening.
Yeah.
But none of them is major. Remember when we had the Palantir IPO and it made shockwaves across the market?
Yeah.
We also had Coinbase. We had this Zoom. We have this app called Bumble.
Robin Hood.
Yeah. Those days we would hear there's an IPO and it would cause news in the market.
Airbnb actually listed during COVID.
Yeah. Uber, Lyft.
Yeah. There has been a drop in IPO globally. I think we are still reeling from the effects of COVID.
Yes.
And therefore, I think I believe the recovery from COVID, based on from a total shutdown of the economy to now the engine's running to a point where we are back to, I wouldn't say pre-2019, but let's say normal levels, whereby things are normal. Before COVID, we had the Greek issue, we had some war going on somewhere. So we are back to that level. And I think that is when now the effect of...
We are back to the same level. There's key things that have changed. Interest rates are really high.
Yes.
Yeah. At the same time...
Cash is out there.
Yeah, people don't have cash. If you look at your budget, the amount of money you are spending per month 1 year ago compared to today, that has really gone up because consumer prices really went up and they haven't come down. They are just slowing, but they're not coming down.
Yeah. I mean, like I said, you notice two things which are quite clear. The price of oil right now is looking to shoot past 80.
Yeah.
And the moment it hits 90, I know it will be felt in people's pocket, especially in terms of either price of production or even just traveling around.
It will affect everything, like transport,
Yeah.
Distribution, consumer prices, imports, everything.
And number two, there is limited food supply globally.
Yes.
So that high demand, of course, means high prices.
Yeah.
And with that now, you combine two things which are very essentials to livelihood.
Yeah.
You have we are basically on a sort of another crisis or something like that. I don't want to sound alarm, but it's actually something of a crisis of some sorts. Yeah.
Yeah. So there's a shortage of rice earlier today.
Yes, there has been with that. Even
And we are just beginning to handle the problem of a shortage of sugar. Like just one disaster after another. Like this year has been really crazy.
It's actually interesting. Now, to trading, I think most traders would be looking at two things, and I know for those who suffered significantly from the ad hoc Bank of Japan decisions, they have had to maybe shift to other assets which are more predictable. And we have seen with the earnings season ending, I think the hype will basically be coming down. So typically, they say during summer break, people basically go off the market. But I think with what is happening right now, they might have to go back to adjust your portfolio a little bit. How are you looking and planning your positions at this time?
For me, I have a bearish bias, especially for equities. I think the valuations don't make sense.
Okay.
I remember in the last quarter, right, that is the first quarter of the year. Every time there would be announcements of earnings that are better than expected, the stocks would normally respond with making a very strong rally. But then what we are seeing with the earnings that are currently happening from the last 2 weeks is a majority of the tech companies reporting better than expected earnings, but the stocks are not responding in the same way. They're not making a big jump because the earnings are good. And that creates something that you need to worry about. For instance, if you look at NVIDIA, it's trading at what? 224 multiple price to earnings ratio. The average for NASDAQ is way lower. I think it's around 30. Same case, SP 500 average is around 20. So if a company is trading at 224 in a bull market, when interest rates are really high, these risks blowing in the real estate sector. Same thing happening in banking. I think it's time to start thinking of a bearish case.
I think with NASDAQ, I think for at the time of the recording, it has been basically forming a falling M. The McDonald M. Always
a double top.
Double top. I think it's almost a triple top now. By the time this podcast is out, it will probably be below around 14,000 or something like that. It is giving me one thing. Every day, based on what I've seen for this week, the first week of August alone. Every day, whatever happens in the European session gets negated in the New York session. Almost every time. With a perfect back to I normally call it the original scene of crime, where the dip started going down. And it's something that I think, as I speak to a lot of traders, maybe for these 2 months where the Fed is basically off the markets, I think they have overstayed their welcome in trying to activate or push some policies into the market. It's time perhaps they stay away a little bit, let the market correct itself. And you would think August having low volumes, it's actually having high volatility compared to months when we had a lot of fundamental releases from 3 central banks doing their rates. It's actually very volatile than even July, I think.
And currencies were actually moving sideways. But right now we are seeing some good volatility. So I'm also very bullish on oil.
That's
the whole situation with Russia-Ukraine war. Really, from an economic perspective, I think it's a war on energy sufficiency. So the fact that the Nord Stream was bombed and now Russia is no longer supplying oil to Europe, what we are seeing here is basically the US exporting oil to the Eurozone. So now there was this mega project running from Nigeria through to Europe, where they would have a big pipeline. It's still in construction. And now there's a geopolitical risk happening in Niger. So as a result of this, if there's a block or basically a stoppage of that particular pipeline, so if there's a block of that particular pipeline, it basically means that Europe continues suffering from lack of energy sufficiency. So as a result of that, we could be seeing the oil output cuts having an impact in the markets, and this could push oil prices higher. So $100 per barrel could be in the books this year.
I think that is very interesting. And that would mean that would be very detrimental to a lot of economies which were just recovering from let's say, the high prices of oil,
Yeah.
and the dollar is still getting stronger.
Yes.
So that adds another problem.
Yeah.
The dollar is way too strong for a lot of economies. I mean, in Kenya, we are dealing at around 140.
Yeah.
I don't want to pick the...
It's 150 today from commercial banks, but from the CBK, it's 140.
Yeah, so I'm trying to stick with what CBK says, not so that I don't cause alarms, yeah?
Yeah.
Now, with that elevated high dollar rate,
Yeah.
I think holding on to dollar at some point is very valuable for the next foreseeable few months, at least.
I wouldn't say that. The supply is increasing massively.
Okay.
Yeah, so while the Fed is tightening on one hand, the US is spending more on the other hand. So I think the next cycle, we'll be seeing a strengthening of commodities. And the only way commodities tend to gain in value is when investors are running away from risk.
Okay.
So while we see some corrections happening in equities, maybe massive sell-offs are happening in bonds, we will be seeing this wealth being transferred into assets that are actually hard. So by hard assets, it basically means assets that are very difficult to come by, things that you can't print. An example would be oil. It would be real estate, infrastructure. So you tend to see those assets gaining, especially when there's a recession.
Okay. Interesting you mentioned that.
Yeah.
Now, gold is going back to 1900s.
Yes.
What is happening there?
Gold, per se, I would say gold is pretty resilient, but then it's suffering from the strength of the dollar. Right now, the dollar demand is too high. What we are seeing happening in the bonds markets is what we refer to as a formal trade. Like there's a lot of people who are trying to squeeze in some very short-term positions
in bonds, right?
in bonds,
Yeah,
to take advantage of the free money.
Yeah, I've seen it. Especially the 10-year paper.
Yeah.
There's been a significant influx in it. If you open Bloomberg
I'm talking about the short term.
The short term, the 3 months,
the 90-day, 6 months, 1 year.
Okay.
Like the yields are way higher with the inversion happening right now.
With the rate.
Yeah. So if you go for a 1 year US Treasury, you're getting like, I think 5.01%.
That's good money.
Yeah. So it's clean money. You just take it. That's what's happening. So anyone with cash, any financial institution in cash,
yes,
they're basically adding more money there, knowing that this is risk-free. They'll just grab that within 1 year.
That makes sense.
So that basically drives dollar scarcity.
You remember, I mean, you're familiar with it.
Yeah.
Santa Rally.
Yes.
The Santa Rally.
Yes.
I think this year it will be a very crazy one.
Yes.
Given the correction in the equity market we're expecting, by December, when now everyone is done cashing out on their short-term T-bills and everything, we will have a very strong rally all through December.
Yeah.
If and whatever decision the Fed makes in the next meeting will be crucial. But I think how people are reacting right now, like I said, if I anytime I check on Bloomberg, or especially on the surveillance, all the conversation from the CIOs and portfolio managers is on one thing. They are not focusing on gold. So that means retail traders are basically shorting gold, taking advantage of its also, gradual fall.
You need to be aware of the geopolitical risk in gold. There's this potential, if there's an all-out war happening in Niger, it affects also their gold output. And not just Niger, but other countries surrounding the area. So we have seen, is it Mali?
Mali, Burkina Faso, Algeria,
all committing to support the country. And Nigeria, being part of the ECOWAS, potentially being the leading force to invade Niger. So if this happens, it could massively disrupt the supply of gold into the global markets. And as a result, that would be a supply-driven bullish run for gold.
Yeah, I think it has been a while since it actually tried those levels, the 1900 levels. So I welcome it very well. I know it is not going to last. For me, I'm looking at it at around 1870 to the lower side. Before now, we have a rally all the way back to, the hard assets, 2000 levels thereabout. But depending on how the economy and everything pans out within Niger and, of course, Ukraine, Russia scenario. Now, as we sort of come to a wrap on it, China. China has basically tried to do a couple of things to spur their economy, but it seems not to be working. They have cut their credit lending rates. They
have cut rates 4 times this year. It's still not working, especially, I almost said not working. So, with China, the big crash that happened last year in
Yeah.
the real estate sector. Remember the Evergrande saga?
Yeah.
Yeah.
So but they are back. They are back into trading, but it
Yes.
literally had a massive sell-off on their portfolio.
So it was just the first domino. There was more companies holding more holes in their books.
Okay.
And now it's coming to reality that some of these companies are insolvent. You can't honor their bonds.
Okay.
So as a result of that, China has had to give them money to try and save these companies. And remember, the real estate sector was a key driver of economic growth, being a very big employer in China. So now that it's slowing down, it's also affecting other things. The other thing is global demand. Global demand has really gone down.
In regards to Chinese products, right?
Yes.
Yeah, because if you look at, I'll bring back the Apple earnings report.
Yeah.
They say that the demand for Apple generally has gone down.
Yeah.
Even some of the companies within the AMD sector have basically turned down. Since our last episode, I think the
And
demand.
Apple's biggest market is China.
Yeah. So if and they have actually have almost a $1 billion plant in $1 billion plant in India.
Yeah.
So they're divesting from China.
Yeah.
I think that has had a significant impact on their growth within the last 2 quarters.
Yeah.
And obviously, as much as people are looking at, normally there is a correlation. If the Chinese economy is growing, the price of oil demand is growing as well.
Yeah.
But recently, there are a lot of factors going about which has superseded China's demand for gold and the expected demand for it, not for gold, but for oil, which has really played a part in its price action.
So what actually happened is that when China removed all COVID-19 barriers, those gains that were locked in different provinces, different cities, they had a lot of savings. I would call them COVID savings.
Yeah.
And they would use these savings to basically travel around. They would do out of local tourism. And this basically showed some very strong signs of the Chinese economy recovering. Remember when all the COVID restrictions were removed in the US, people went all out shopping, and some of the best performing companies were like Crocs. I remember Crocs was up over 100%.
Yeah, Costco, Walmart. Yeah.
So now, for China, there was this optimism that there would be very fast recovery, similar to what was happening in the US. But then data coming from manufacturing PMIs, services PMIs showed that the recovery is not that strong. So as a result, the producers in China, anticipating this demand, they basically created way higher production, operated at a very high capacity, looking to take advantage of the recovery. And now, realizing that the consumers are weak, both internally and externally, they are trying to push these products out of their warehouses. In order to push more out, they have to lower prices. So the fact that they've been cutting prices, including Elon Musk. You remember Elon Musk cutting the price of Tesla in China? Yeah. So the fact that they're cutting prices, it's leading to what we call deflation. So from the data we saw this morning, Chinese inflation is now at negative 0.3%. Yeah.
Yeah. You know what? I think people ignore one thing about what COVID did to consumption and expenditure.
Yeah.
Whereby you are indoors, you discovered a skill, forex trading, you get in there, you do your thing, you're self-sufficient.
Yeah.
You get into stock market, like in US, you have Robinhood, basically commission-free trading.
Yeah.
You do a very nice game stock, you're up $10,000, you are set for life.
Yeah.
You do what is his name? What is this name? This breakfast show with the Charlemagne, the other DJ Envy, what it does, buys, let's say, dilapidated houses, renovates it, sells it off, you're done. Airbnb comes in during COVID time.
Yeah.
It's basically does an IPO, you buy it at basically.
We had a rugby player who turned into a very good chef.
Yeah. So people basically discovered, okay, so I have a lot of time, maybe I can invest in my skills.
Yeah.
And therefore it has led to expenditure change in how people value their money and their time, and even actually how they invest or manage their money.
Yeah.
So
it actually changed the way we live.
Yeah.
Change how we live.
Yeah.
For instance, most people didn't see the value of having an office at home.
Yeah.
Having, let's say, a desktop, video streaming equipment.
Yeah.
A lot of people didn't invest in entertainment at home, but then being forced to stay at home, you start thinking of way to,
you need actually a good surround system to enjoy your movie.
And that basically changed how we spend money.
Yeah. So I think that is what we are feeling right now. Like I said earlier, we have come from a total shutdown of the economy to now a full steam economy running.
Yeah.
And then now people are like, okay, now we are back to normal.
Yeah.
What do we do?
Yeah.
So people are choosing to do different things. I think one of the suffering companies, some of the suffering companies are especially on the luxury consumer products.
Yeah.
There is no much uptake to it, and that has played a role in how their revenue comes along. And obviously, in terms of what was very high in terms of during the COVID period, delivery services. So you'd find these restaurants which would deliver would get a lot of revenue.
So last week I saw something similar. I think it was the leader of LVMH, the luxury brands CEO in France. Basically saying that the performance of the company has really gone down as a result of weaker demand from the US. Like Americans are no longer buying these exclusive products the same way they were doing right after COVID.
Yeah, it's actually an interesting time. So I think as we go to the close of the year, I think for me, like I mentioned last time, of course, energy markets, I'll be going to look at the energy market significantly. I think gold, we are waiting for the confirmation of the correction before the price appreciation.
How do you think the new iPhone will perform?
I don't think it will perform good. I don't think that if the sales of 14 have really not performed well, I don't think it will perform better than last year. So I think the sales will not really be up there. I think it's the services, like I mentioned earlier, the services business of Apple is what will really drive it, not the product sales. The product sales, I don't think they'll go up that much.
Interesting. Every time Apple is about to release a new iPhone, there's usually a lot of critics. Oh, the economy is this. Oh, the consumer is weak. But eventually, somehow Apple proves everyone wrong.
I agree. I'm not. What I'm saying, based on their last three flagship phones, the premium model, ignore the medium range. The premium model have not really met the sales expectations. And I think it's because the prices have kept on going up, but the modification has not really gone up. And like you said earlier, people are valuing their money differently. So that has played a part in, okay, do I really need to upgrade? And of course, we have the US credit limit has hit 1 trillion. It's not like Kenya where you pay cash money. Them they use, at least you can turn it in with the credit. So if you have already hit your credit limit, you might want to consider, okay, how do I first of all pay my mortgage before I get
the credit limits are expanding. It's not a difficult problem. The problem is that the size of the massive debt has grown to 1 trillion. It's basically a stimulus package. It's basically Americans spending 1 trillion every month without having worked for it. So they're basically spending tomorrow's income. So it only gets worse if you're late to pay, where interest rates have gone up to 22%.
Anyway, we'll see how it goes. I think in a few months, we shall, not in a few months, next year, by Q2, we shall see what sales of 15 has been, and more importantly, their recently released new product, the gaming device and everything.
Definitely. When's the poll results coming from the APV awards?
I think we'll get to know it in October. In 2 weeks. No worries. We'll know by October. I mean, we are winners, so.
So, in 2 weeks, you get to see the official outcome.
Yes. Any closing remarks, and of course, what you'll be watching for the next couple of weeks?
For the next couple of weeks, I'm very interested in seeing the appropriate mix of data from the US. So I'm very much interested in what happens with the CPI this week. And of course, once we see the CPI, the PCE price index for this month, once we get to those two data points, we will know whether inflation is getting back to 2% or whether there's a big spike. If there's a big spike in US inflation, then this could change a lot of things. So thank you for the...
I didn't have a very hard questions today, but I think if you did not find it, if you have rather follow-up questions on the geopolitics and how they affect the markets. I hope we have covered it sufficiently. Feel free to ask away questions, interact with us on Twitter, Facebook, if people still use Facebook, Instagram, and TikTok.
I don't use Facebook.
Other than that, have yourself a wonderful trading and peaceful week ahead. Adios.
Awesome.